If you got a tax refund this past year or over the past several years, should you reduce your tax withholdings? I've got that process and idea, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so how do you define success when you're getting your taxes done? Most people say it was a success if I got money back. It was a failure if I owe money. And I get that, right? That's understood. However, I would define it differently. I would define, and I'd encourage you to define, a financial success or a success on your tax return as you captured all of the right ideas to pay the least amount of tax over your lifetime. So all of the tax planning ideas you captured. You got the maximum amount of deductions and tax credits that made sense for you to employ. That's what I would call a success. And I would call a failure as you got a tax surprise. No one likes surprises. And you should avoid them but through the planning process. So getting a refund that suggests you got as many tax deductions and credits as possible, but not always. Not always. In fact, owing your taxes could feel like, well, yeah, I was penalized. But if you got all of the tax credits and deductions and did all the appropriate tax planning and still owed a little bit, but it wasn't a surprise, you were aware of that, fantastic. See, what many people fail to realize or fail to connect the dots on, if you got a refund, it effectively means you just paid more money in. You had too much withheld, and therefore you got a refund. Now, and you hear me, I'm not suggesting you should break even every year or you should owe every year. It's personal preference. To me, if you owe every year, that means penalties to the IRS, and that's bad news for many people. So to me, our definition of a successful tax season for you is identifying and capturing all of the right tax planning opportunities so that you can pay the least amount of tax over your life, if not multiple lifetimes. And then that you've done the appropriate tax planning to avoid surprises. Now, there's no way to anticipate everything, and there will always be things that come out of left field, but you've done the proactive work on your taxes to identify and implement those strategies to reduce tax, and that's allowed you the ability to say, yep, I'm pretty confident where I'm going to land with my tax return this year. That entire process, as geeky as it sounds, we absolutely love it. That's the tax planning process, and tax planning is one of the 6 areas of financial planning. And that's why you need to be working with a CFP that is also doing tax planning and working with your CPA. That's why we have a team full of CFPs on our team and a team full of CPAs. And many of our CPAs are also CFPs as well. That's the level of integration that you need. With that backdrop, I was a bit surprised personally when I got an email from a client last week. This client, he's been growing his income steadily. He's been working hard, been growing in his career. And when I first met him a few years ago, we started doing that tax planning work. And I gave him the bad news that, listen, you make too much now and you can't fund that Roth IRA. Thank goodness. It was sort of by happen chance that we got connected. And it turns out it was at that exact time where I told him, you're funding that Roth IRA every year and you're going to make too much money. You're not going to be able to do that. And I had to convince him that that's how the rules work, number one. But as his income continued to grow, it then shifted from, you can't fund the Roth IRA to the withholding tables aren't set up for you. Just the normal withholding tables of you filing, exemption single with no exemptions, they're not going to withhold enough income or enough tax for your situation. You need to have them withhold more and more. And so that's been the process over the past 4 or 5 years. Well, so here, last week, I got an email from him saying, so should we adjust my withholdings back down? I got that $1,200 tax refund. Do we need to make any adjustments? Now, kudos to him for recognizing what I had just shared to you, and that is, if I got a refund, it's simply because I just paid in more money than really I needed to. So I deferred more of my own money and gave it to the IRS, and then I just needed to receive it back. But to me, with the amount of income that this individual is receiving, about $200,000 of income, being within $1,000 or $1,200 is actually, to me, I'd call that pretty close. Most people do, once they get the planning process and we're going through and we are capturing all of those tax planning ideas and avoiding surprises, they want to be as close to break even as possible, but most people would err on getting a little bit of a refund just to make sure that they don't owe each and every year and helps with cash flow. So a $1,200 refund on a single individual earning about $200,000, a little bit more than that, to me, I'd call that close to break even, but erring on the right side. So here was the situation. Let me resolve the story or give you the conclusion. The reason why that individual got that much in a tax refund was that their capital gains from their investments actually there weren't any, right? Where the capital gain distributions, which we manage very tax sensitive investment strategies, but there can still be some that trickle out. And what we had anticipated coming out for capital gains, or let me say it differently, what I had wanted to be prepared for so that we avoided a surprise was a certain amount of capital gain distributions from, a lot of it's ETFs, but from a couple mutual funds that this client has held that have very low cost basis and could be taxable if we sold them, blah, blah, blah. I wanted to be prepared to cover that with taxes if that ended up being the case. And it wasn't the case, because while a lot of people had a lot of capital gain distributions on their mutual funds, even though they were down last year, the specific mutual funds that this individual had, there was very little capital gains. Also, I was anticipating that the interest income might be a little bit higher than what the individual had seen the year before, because interest rates were going up. And turns out the interest income was higher, but not as high as I anticipated. So I ended up telling the individual, actually, no, likely this year interest income will be even higher, and capital gain pass-through, capital gain distributions could be back at that higher level that I anticipated. Therefore, we were prepared for a little bit more tax than what actually came last year, and that resulted in a tax refund, but I would still be prepared for those same things this year, and I wouldn't make any adjustments to your withholdings. That's the level of tax planning that you need the level of proactive tax planning work that you need. Because embedded within this, and I haven't even shared it, is that we've identified, well, what's the 401k, what's the tax shelter strategy that makes the most sense so that you're deferring the most amount of tax or the most amount of income so that you're paying the least amount of tax over your lifetime or multiple lifetimes. We've already checked all those boxes, and we'll continue to do that on an ongoing basis each and every year as we're analyzing this individual's tax situation. So work with your certified financial planner. Hopefully that helps better define how you should define a successful or a failure or a fail tax situation. Work with your certified financial planner. Get that tax planning as part of your comprehensive financial plan. If you don't have a CFP that can help you with that, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.